Welcome to this Talk Tickers Deep Dive. Our mission here is always the same, right? Translating these incredibly dense Wall Street earnings calls into actionable, data-forward insights in under 5 minutes.
Right.
But look, today's target might require us to really get into the weeds. We are looking at Flexsteel Industries.
Ticker symbol FLXS.
Exactly. Specifically, we're putting their Q2 2026 earnings call under a microscope. And honestly, if you are holding this stock, or honestly, even if you're just watching the consumer discretionary sector, this is basically the ultimate case study in corporate survival tactics.
Oh, absolutely. It's survival tactics versus just massive macroeconomic headwinds.
Yeah, because usually, when a company grows its top line sales for 9 consecutive quarters, you just assume you're looking at a booming macro environment. You assume there's a rising tide lifting all ships, consumer confidence is through the roof, and people are just opening their wallets with reckless abandon.
Right. You see the revenue chart going up and to the right, and you instinctively conclude that the entire sector must be firing on all cylinders.
That's exactly. But right now, in the middle of severe inflation, totally fractured supply chains, and a consumer base that is arguably exhausted, a legacy furniture company is pulling off the impossible. I mean, they are growing in an environment where, frankly, they should be shrinking.
It really completely defies gravity. Because look, if you look at the consumer discretionary sector broadly and, the home goods and furniture industry specifically, we are in the middle of a multi-year hangover.
The COVID boom.
Exactly. The boom of 2020 and 2021 pulled so much demand forward. Everyone bought a new desk, a new couch, a new patio set because they were trapped at home. And then the music just stopped.
Right.
The industry has been essentially digesting that glut ever since, leading to a brutal contraction for most players. So to post uninterrupted growth through that exact contraction period, it means this company is operating on a fundamentally different frequency than its peers.
And that is the central tension we are unpacking today.
Yeah.
How does a furniture company manage to grow sales in a choppy economy while staring down the barrel of massive punitive taxes on their supply chain? So let's start with the headline numbers, because the sheer scale of the anomaly is wild. Flexsteel just reported Q2 net sales of $118.2 million.
Wow.
Right.
Wow.
That is a solid 9% increase year over year. And like I said, this is their 9th consecutive quarter of sales growth.
9% growth in a market where competitors are posting mid-single digit declines or worse.
Yeah.
The magnitude of that outperformance really cannot be overstated. When a legacy manufacturer, one that has been around for decades, suddenly starts taking market share from leaner, arguably more modern competitors in a down market, you have to look at the operational levers they are pulling.
For sure.
It is not an accident. It requires a ruthless, almost predatory level of execution.
Predatory execution. I like that. That's a great way to put it, because when you look at the surface, everything seems shiny. But as anyone who listens to us knows, the surface numbers on Wall Street are often a mirage.
Always.
Yeah, exactly. To find the real execution, you have to dig into the profitability metrics, and specifically the chasm between GAAP accounting and adjusted operating income. So the official generally accepted accounting principles, GAAP, put their operating income at $9.0 million for the quarter.
Right.
Which translates to an operating margin of 7.6%.
Which, in isolation sounds perfectly respectable for a furniture manufacturer navigating a tough macro environment.
It really does, until you load up a standard algorithmic stock screen.
Oh, right. The machine.
Yeah, the algorithm. If I am just a casual investor running a quick screen on my brokerage app, the algorithm pulls last year's Q2 GAAP operating income, which was reported at $11.7 million.
Right.
So the machine looks at $11.7 million last year, looks at $9.0 million this year, and just flashes a massive red warning sign. It tells me operating income just plummeted. It tells me the company's losing its edge, margins are compressing, and I should probably sell.
And that is exactly the danger of passive algorithmic investing. Because those stock screeners are scraping raw XBRL data, the standardized financial reporting format, without any contextual understanding of the underlying business mechanics.
They just see the drop in the number.
Exactly. They lack the ability to distinguish between recurring revenue from core operations and isolated, non-recurring windfalls.
And I'm looking at the footnotes here, and the windfall you're talking about is literally a piece of real estate.
Yes.
Last year's $11.7 million GAAP operating income included a massive $5 million gain from selling a former manufacturing facility down in Dublin, Georgia.
Precisely. Because under standard accounting rules, when you sell an asset like a factory for more than its book value, that gain flows through the income statement. It boosts your operating income for that specific quarter. Now, it is entirely legal, it is completely accurate accounting, but it is fundamentally deceptive if you are trying to measure the health of the core business.
Yeah, because you do not buy shares in Flexsteel because you think they are savants at flipping industrial real estate in rural Georgia.
No, you buy them to manufacture, ship, and sell furniture at a profit.
Right. The real estate play is just highly profitable noise. So if we strip out the $5 million factory sale from last year's numbers, we drop from $11.7 million down to an adjusted $6.7 million.
Correct.
That $6.7 million is what they actually made selling furniture last year. And this year, without any factories to sell, they made $9.0 million.
And when you perform that simple adjustment, the narrative violently reverses. Instead of a catastrophic decline, you are looking at a business whose core operational profit literally exploded by 35% year over year.
35%. That's huge.
They went from generating $6.7 million from their actual operations to $9.0 million. That is a staggering leap in efficiency during a period where freight costs and material costs were incredibly volatile.
Yeah, and the margin expansion is what really catches my eye here. They widened their operating margins by 150 basis points, jumping from 6.1% to 7.6%.
Right.
Expanding margins while dealing with a fatigued consumer is just incredibly difficult. It tells me they aren't just selling more volume. They are making a little bit more money on every single piece they sell, or they have stripped significant fat out of their overhead.
It is a combination of both, really. Management referred to these gains as, quote, increasingly structural in nature.
Structural?
Yeah. They are citing sales leverage, meaning they are getting more revenue out of their existing fixed cost base and sweeping productivity improvements across their manufacturing footprint. They are simply running a tighter, more disciplined machine than they were 12 months ago.
Well, speaking of disciplined machines, we absolutely cannot talk about their financial health without looking at the balance sheet. I mean, management was practically shouting this from the rooftops during the call. They were sitting on $36.8 million in cash.
Yeah.
But the real headline, the piece of data that acts as a fortress around this entire company, is zero bank debt.
Zero. In a macroeconomic environment where the cost of capital has essentially tripled over the last few years, zero bank debt is the ultimate competitive weapon.
It changes the entire physics of how you run the company. I was thinking about it like a casino player who is only playing with the house's money.
That's a great analogy.
Right. While all the competitors at the poker table are taking out predatory payday loans just to stay in the game, sweating every single hand because the interest payments are crushing them, Flexsteel is sitting on a massive stack of chips, completely immune to the rising table minimums. They just don't have a ticking clock forcing them to make desperate moves.
The casino analogy is perfect because debt introduces a dynamic of forced compulsion.
Explain that.
Well, if a heavily leveraged competitor experiences a sudden drop in consumer demand, they still have to service their debt. The bank does not care if foot traffic is down at retail furniture stores. The interest payment is due on the first of the month.
No matter what.
Exactly. So to generate the cash to make that payment, the leveraged competitor has to heavily discount their inventory. They slash prices by 30 or 40% just to get cash in the door quickly.
Which completely destroys their margins.
It obliterates their margins. It cannibalizes their future sales. It devalues their brand. And it puts them on a treadmill where they have to sell twice as much product just to stand still.
Wow.
It is a classic corporate death spiral. But by holding zero bank debt, Flexsteel completely opts out of that death spiral. They have the luxury of holding the line on pricing. If demand softens for a few weeks, they can simply wait. They don't have to panic discount.
I see the structural advantage there, but I really want to look closely at how they are generating this top-line revenue. Because a pristine balance sheet doesn't entirely explain how they are pulling off 9% growth in a shrinking market.
Fair point.
To figure that out, we have to look at what they are actually charging people. Which brings us to the most complex dynamic of this entire quarter, the tariffs. We just praised them for hitting $118.2 million in sales. But if we're in an inflationary environment, heavily burdened by supply chain taxes, I have to ask, is this real growth or is this just inflation masquerading as growth?
And you are hitting on the critical distinction between revenue quality and volume. Are they capturing more market share by moving more physical units, or are they just slapping a heavier price tag on the same number of units to cover government surcharges?
Right, exactly.
The chief financial officer, Mike Reffler, provided the exact key to unlock this math on the call. He explicitly stated that tariff revenue in the quarter accounted for roughly $9.5 million of their total sales.
Let's look at that math for a second. They reported $118.2 million in total sales. That is an increase of about $9.7 million from the prior year's $108.5 million.
Right.
And the CFO is just admitting that $9.5 million of that revenue came purely from tariff surcharges passed directly on to consumers.
The numbers align almost perfectly. When you strip out the money they collected solely to pass along to the government for import duties, the actual core revenue growth practically evaporates.
Wow.
From a unit volume perspective, management openly acknowledged that they were relatively flat versus the prior year. The volume of physical furniture leaving the warehouses did not increase in any meaningful way.
Okay, so the 9% growth is basically an illusion.
Well,
I mean, this is a pricing mirage, right? They didn't sell 9% more couches. The couches just got significantly more expensive because of supply chain taxes. Honestly, if I'm holding this stock, I'm slightly terrified by that. Flat volume implies stagnation.
it implies stagnation if you view it in a vacuum. But context is everything here. I look at that exact same data point flat unit volume while passing on nearly $10 million in price hikes, and I see an astonishing demonstration of pricing power.
Really?
Astonishing.
Absolutely. Think about the elasticity of demand. Generally, if you raise the price of a discretionary item by a significant percentage, demand should logically contract. The consumer should balk.
They should just say no and walk away.
Right. The fact that Flexsteel successfully forced the market to absorb $9.5 million in surcharges and the consumer still bought the exact same volume of furniture is incredible.
You're saying their consumer is highly inelastic, at least up to this point? Like,
Yeah.
they are sticky enough to just swallow the inflation.
It proves brand loyalty and perceived value. It means the consumer looks at a Flexsteel sofa, sees the higher price tag, and determines that it is still a better value proposition than trading down to a cheaper, lower quality alternative.
That makes sense.
That kind of pricing power is rare, and it is a massive defensive moat during an inflationary cycle.
Okay, I agree with the pricing power thesis, but we can't treat Flexsteel's entire customer base as a monolith either, because a flat average volume usually means some segments are surging while others are collapsing to balance out the math. And when you look at their product portfolio, there is a massive divergence between the winners and the losers.
There really is. The divergence tells us exactly where the American consumer is financially stratified right now.
Yeah.
On the winning side, their source soft seating volume is up. But the real engine driving the premium side of the business is their new product introductions. The CEO, Derek Schmidt, highlighted that over the last 6 to 8 quarters, new products have accounted for a staggering 30 to 40% of their overall sales.
30 to 40%. Generating that much of your revenue from products that literally did not exist 2 years ago is a massive achievement in research and development.
It really is.
It keeps the brand from feeling stale. And logically, a new product is going to command a higher margin. You don't spend millions designing, prototyping, and launching a brand new recliner just to price it at a discount on day one. You launch it to capture a premium.
It is the absolute lifeblood of gross margin expansion. It proves their design teams have a razor-sharp read on shifting consumer aesthetic preferences and functional needs.
For sure.
But you know what I found particularly fascinating during the Q&A portion of the call? It was the CEO's extreme hesitation to provide any forward-looking details about that specific product pipeline.
Oh, right. The analysts were pressing him for details on what comes next, and he completely stonewalled them.
Completely.
He refused to give specifics, citing the threat of rapid duplication by competitors, and he specifically mentioned the use of artificial intelligence.
It is a stark reminder of the new reality in manufacturing intellectual property. Look, in the furniture industry, a unique design is your primary IP, but it is notoriously difficult to protect with patents compared to, say, software or pharmaceuticals.
Right, it's just a ship of a couch.
Exactly. Historically, if you unveiled a new design at a trade show, it would take a competitor months to reverse engineer the dimensions, source the materials, set up the tooling, and ship a knockoff from overseas. You had a solid window of exclusivity to capture the premium market.
But AI has just collapsed that window.
It has absolutely obliterated the window. A competitor can now take a rendering or even just a photograph of your new design, feed it into a generative AI tool, and instantly output a highly optimized bill of materials and manufacturing schematics.
That is wild.
And then they can send those automated specs to a low-cost factory in a jurisdiction that ignores IP laws and have a cloned product ready to ship in a fraction of the time it used to take. So the secrecy from Flexsteel's management isn't paranoia. It is a necessary defensive posture to protect their only real margin driver. If you telegraph your moves, you are basically giving away your margin.
Wow. Okay. So they have this highly secretive, highly successful premium product pipeline, keeping the top line afloat. But we have to look at the other side of the portfolio because the floor completely fell out of their budget segment.
It really did.
The Homestyles brand, which is their ready-to-assemble business, saw sales drop by nearly 50%. 50! And you don't lose half your revenue in a segment by accident.
No, a 50% contraction is a structural collapse. It is a localized depression for that specific brand. To understand why, we have to dissect what the ready-to-assemble or RTA market actually is.
Okay, break that down.
This is the flat pack, put it together yourself with an Allen wrench furniture. It is the IKEA model. And structurally, it appeals to a very different demographic than the consumer buying a premium custom upholstered sectional.
It is the ultimate budget-conscious consumer. It is the college student furnishing an apartment, or maybe the young family stretching their paychecks.
Exactly. And that specific consumer demographic is the canary in the coal mine for the broader economy. They are the ones feeling the absolute heaviest burden of inflation at the grocery store, at the gas pump, and in their rent payments.
Yeah, it says don't have any buffer.
Right. When your grocery bill goes up 20%, your discretionary income basically evaporates. You do not go out and buy a $200 flat pack TV stand. You just make do with what you have. The premium buyer might still have the stock portfolio and the disposable income to absorb a tariff surcharge, but the budget buyer has completely exited the market.
It is a vivid proxy for the two-tiered economy we are seeing everywhere. And the softness wasn't entirely isolated to Homestyles either. They also admit that made-to-order seating was soft.
Yes.
Which honestly makes psychological sense to me. If I am feeling uneasy about the broader economy or worried about my job security, I might still buy a couch, but I want it now. I am not going to commit thousands of dollars to a highly customized, non-refundable piece of furniture that takes 12 weeks to manufacture and ship.
The anxiety of waiting is just too high.
Exactly. I want what is in stock, in the warehouse, ready to deliver tomorrow.
Which is the perfect segue to the most glaring anomaly on their balance sheet. Because to give the consumer what they want instantly, you have to have it physically sitting in a warehouse. And Flexsteel's working capital, the money tied up in day-to-day operations and physical inventory, just swelled to a colossal $126 million.
A $126 million stockpile.
Yeah.
When I saw that number, my jaw literally dropped. It is an astronomical amount of cash to freeze in physical assets.
It's massive.
I mean, it looks exactly like panic buying at the grocery store before a massive generational blizzard. You know the storm is coming. You know the roads are going to freeze. And if you were forced to buy milk and bread during the storm, the price is going to be ruinous. So what do? You drain your checking account, you rush to the store, and you buy an entire month's worth of non-perishable goods.
That's spot on.
You convert your liquid cash into physical assets to insulate yourself from the impending price shock. Flexsteel is doing the exact same thing, but instead of hoarding canned beans, they are hoarding shipping containers full of couches.
The defensive posturing is brilliant, but we really need to understand the exact catalyst for the panic. The CFO stated clearly that this $126 million stockpile was an intentional accumulation of their top-selling inventory ahead of a looming tariff hike scheduled to hit on January 1st.
Okay.
They knew the cost of importing their core products was about to skyrocket by 25%. So the most mathematically rational decision a management team can make is to import as much volume as physically and legally possible on December 31st, locking in the lower historical cost basis.
But warehousing that much physical product comes with immense risks. It is not like buying stocks where the carrying cost is effectively zero. Storing heavy, bulky furniture is incredibly expensive.
Oh, the logistics of a $126 million stockpile are staggering. We are talking about millions of cubic feet of warehouse space. You have to pay rent on those facilities. You have to insure the inventory against fire, flood, and theft. You have to pay logistics personnel to manage it.
It adds up fast.
And beyond the physical carrying costs, you introduce a massive element of obsolescence risk.
Wait, obsolescence in furniture? You mean the risk that tastes change?
Absolutely. They placed a 9-figure bet that they know exactly what the American consumer will want to buy over the next 6 to 9 months.
Wow.
What if they stockpiled the wrong color palette?
Oh, wow.
Right. What if a new trend emerges and suddenly nobody wants the specific fabric they hoarded? If that inventory sits too long, it becomes dead weight. They would eventually have to liquidate it at steep discounts, destroying the very margins they were trying to protect from the tariffs in the first place.
So they essentially built a massive wall of inventory to protect their Q2 margins, and it worked flawlessly. The strategy was a complete success in the short term. But here's the problem eventually. You have to start selling that inventory, and when you do, you have to replace it. Which brings us directly to the future and how management is preparing for what happens when the stockpile runs dry.
Yes. This is where the narrative shifts from looking backward at a successful quarter to looking forward at a highly precarious reality.
The analysts on the call wanted what they always want: certainty. They want exact mathematical guidance for the next quarter so they can plug it into their models and generate a price target. But Flexsteel's management did something that almost always triggers a panic on Wall Street.
They paused it.
They formally paused all forward-looking guidance. They outright refused to give specific financial targets for the upcoming quarters.
Pulling guidance is the corporate equivalent of flying blind in a thunderstorm. On Wall Street, uncertainty is often punished far more severely than actual bad news. Oh yeah, if a CEO comes out and says, "We are going to miss our earnings target by 10% next quarter due to supply chain issues," the algorithmic traders and hedge funds will instantly reprice the stock. It will take a hit, but the market digests the known variable and move on. The risk is quantified.
But if you say, "We have no idea what's going to happen,"
if you claim total blindness, the market's imagination just runs wild. In the absence of data, investors naturally assume the absolute worst-case scenario. It invites massive volatility. So for a management team to willingly invite that volatility by pausing guidance, they must believe that the alternative, issuing a forecast and subsequently missing it by a wide margin, is significantly more damaging to their long-term credibility.
they justified the pause by citing a total lack of macroeconomic visibility, wild swings in consumer behavior, and an evolving, highly politicized tariff policy environment. And honestly, it makes logical sense. How can a CFO accurately predict profit margins for August when the government might arbitrarily alter the import tax rate on raw materials in July? How can you project consumer demand when inflation data is causing retail sentiment to whip back and forth every single week?
You cannot. Attempting to provide highly precise financial models in a highly imprecise environment is just a fool's errand. It is a sign of mature leadership to admit the limitations of their forecasting models rather than peddling fiction just to appease short-term analysts.
But they didn't leave the analysts completely empty-handed. They may have paused the official numbers, but they dropped a massive, heavily telegraphed warning about the second half of fiscal 2026. The CFO warned them, point blank, to expect margin dilution.
And this is the inevitable consequence of that January 1st tariff hike.
Yeah.
This is the mechanical reality of inventory accounting catching up to them.
Let's trace the mechanics of this margin squeeze because it's so important. It goes back to the panic buying. They have this $126 million fortress of low-cost inventory. They're selling out of that fortress right now, which is why their margins look fantastic. But every time they pull a couch out of the warehouse and sell it, they have to order a new one from overseas to replace it.
Correct. And under standard first in, first out, or FIFO accounting principles, the cost of goods sold on the income statement matches the oldest inventory first. So right now, the P&L looks pristine, but the pipeline is actively filling up behind the scenes with replacement inventory that is burdened by the new punitive 25% tariff.
So when that pipeline finally reaches the warehouse and they start selling the new stock, the cost of manufacturing and importing that couch has essentially skyrocketed by 25%.
Yes. And when the cost of goods sold spikes by 25%, a company is faced with an impossible binary choice.
Okay, what are the choices?
Choice A, you absorb the cost. You keep the retail price the exact same. You pay the government the 25% tax out of your own pocket, and your profit margin completely collapses. That is the margin dilution the CFO is warning about.
And choice B, is you raise the retail price by 25% to protect your margin. But we just talked about how exhausted the consumer is. If the budget RTA market is already down 50%, trying to force another massive price hike onto the premium consumer feels like playing Russian roulette with your demand curve.
It is the ultimate bind. If you protect your margin, you destroy your volume. If you protect your volume, you destroy your margin. Management is essentially conceding that they will likely have to employ a hybrid approach.
Right.
They will raise prices as much as the market will bear, but they will still be forced to eat a portion of the tariff costs internally, leading to a mathematically unavoidable contraction in profitability.
It sounds incredibly bleak, a guaranteed margin squeeze combined with flat volume. But this is where the Flexsteel story pivots from pure defense to surprisingly aggressive offense. They aren't just sitting back, waiting for the tariffs to erode their profits. While they are playing a defensive game on the supply chain, they're executing a highly targeted, aggressive expansion on the distribution side.
And the distribution strategy is perhaps the strongest long-term signal in the entire earnings call. Despite the macro gloom, management outlined a deliberate initiative to target and capture 20 specific, large, independent retail accounts across the country.
The focus on independent retailers is fascinating to me. If I am trying to move massive volume quickly, my instinct would be to go to the biggest national big box chains. Why focus on regional independents instead of fighting for floor space in a 500-store national conglomerate?
Because the nature of retail furniture sales is deeply rooted in local trust and highly personalized service areas where large independent retailers historically obliterate the national big box chains.
How so?
Well, a dominant regional player usually has deep multi-generational ties to their specific community. They understand local aesthetic preferences. They invest heavily in well-trained sales staff who can actually guide a consumer through custom upholstery options, and they handle white glove delivery with their own local teams.
So they aren't just treating a sofa like a commodity on a shelf.
Exactly. Furthermore, the top-tier independent retailers are heavily investing in robust omnichannel strategies.
Explain how omnichannel works for a 200-pound piece of furniture. It's not like buying a pair of shoes online.
No, it is fundamentally different. Omnichannel in furniture means acknowledging that the modern consumer journey is hybrid. A customer might spend 3 weeks browsing a retailer's website, looking at dimensions, comparing fabric swatches digitally, and reading reviews.
Right.
But before they finalize a $3,000 purchase, they want to physically sit on the couch. They want to feel the density of the foam. So the omnichannel strategy seamlessly bridges that gap.
Got it.
The customer walks into the local independent showroom. The salesperson pulls up their digital cart, guides them to the physical floor model, finalizes the custom fabric choice, and coordinates the local delivery. By integrating deeply with these 20 massive independent players, Flexsteel is tapping into highly efficient, high-conversion sales funnels that big box stores simply cannot replicate.
They are essentially piggybacking on the local trust and technological infrastructure of these elite regional players. And management noted that while they already have established relationships with most of these 20 targets, there is a subset of emerging relationships that offer exponential growth potential. They are actively hunting for market share while their competitors are distracted by debt obligations.
It is a dual-track strategy. Track 1 is sheer operational survival stockpile inventory, mitigate tariff impacts where possible, and maintain the zero-debt fortress. Track 2 is aggressive market share acquisition, launch higher-margin new products, and lock down the premier independent distribution channels.
Which brings us to the synthesis of all this data. We have mapped out the fortress balance sheet, the illusion of the 9% growth, the catastrophic collapse of the RTA segment, the $126 million inventory gamble, the withdrawn guidance, and the aggressive independent retail strategy. The question is, what do we actually do with this? If I am looking at this stock, how do I weigh the short-term mathematical pain against the long-term strategic vision? I am going to be honest, I cannot look past the next 6 months. If I'm holding this stock right now, I am terrified of this impending margin squeeze. I look at this fundamentally as a bearish setup in the near term.
Look, I understand the apprehension. The math of the 25% tariff hitting the cost of goods sold is undeniable. The margins will contract.
They have to. They are going to chew through that low-cost inventory stockpile, and suddenly the reality of the supply chain taxes is going to hit the P&L like a freight train. And you cannot ignore the demand side either. The 9% top-line growth is already a mirage, masking totally flat volume.
True.
Volume is flat before they try to implement the next wave of price hikes to cover the new tariffs.
Yeah.
Volume is almost guaranteed to go negative when those prices actually hit the floor. The consumer is telling us they are exhausted.
Yeah.
The 50% drop in the Home Styles brand proves the breaking point is already here for the lower income demographic.
Yes, the budget consumer is tapped out.
It is only a matter of time before that financial exhaustion creeps up the ladder to the premium buyer. The stock is going to get punished when those margins officially drop.
The short-term mechanics you are describing are entirely valid. There will be a valley. The numbers will likely look ugly in Q3 and Q4. But I think viewing this through a 6-month window misses the entire strategic architecture of the company. I see this as an incredibly robust, long-term bullish setup precisely because the environment is so toxic.
Wait, you are buying into the pain?
I am buying into survival of the fittest. You have to evaluate a company relative to its competitive landscape. Yes, Flexsteel is facing a margin squeeze, but their competitors are facing existential crises.
That's a huge difference.
Exactly. Flexsteel's management has engineered a business with zero bank debt. That means while other manufacturers are literally going bankrupt or degrading the quality of their materials just to make interest payments, Flexsteel is investing heavily in a new product pipeline that is already driving 40% of their revenue. They have already demonstrated the pricing power to pass on $9.5 million in costs without losing core volume. They are going to use this macroeconomic storm to drown their weaker competitors, secure the best retail floor space with those top 20 independents, and when the dust finally settles, when tariffs stabilize and consumer demand eventually normalizes, Flexsteel will emerge with a dramatically larger share of the overall market.
I hear your optimism about their structural dominance, but I also hear you conceding that the next 2 quarters are going to be a bloodbath for their profitability. So if we translate this into actual actionable strategy for the investor listening right now, it sounds like timing is everything.
Timing and emotional discipline. If you already own shares of Flexsteel, your best action is likely inaction. You hold the position. The pristine balance sheet guarantees they're not facing a liquidity crisis. They are not going to zero.
Right, the zero debt saves them.
You will have to endure some severe volatility as the algorithmic traders react to the lower margins in the upcoming quarters. But the underlying structural thesis of the company is fully intact. You simply wait out the storm.
And if you don't own it, if you have cash and you are looking at the consumer discretionary sector, waiting for an entry point.
If you are looking to initiate a position, you sit on your hands, you hold your cash, you wait for the margin squeeze to inevitably materialize. Management has practically handed you the playbook. They told us margins are going to drop. When they officially report those compressed margins in Q3 or Q4, the short-term momentum-driven investors will panic and sell off the stock. That sell-off will artificially depress the valuation, creating a massive temporary dip.
So you let the short-term panic create your long-term entry point. You wait for the algorithms to overreact to the margin compression, and you buy the dip knowing that the zero-debt foundation is bulletproof.
Exactly. You buy the company for where it will be in 3 years, but you use the predictable 6-month chaos to secure a cheaper price. This is the entire value proposition of digging into earnings call transcripts. You cannot formulate that kind of strategic patience by just reading a headline that says, sales up 9%.
You absolutely cannot. You have to dig into the footnotes, pull apart the gap accounting, and track the physical inventory moving through the supply chain. And that brings us full circle to the very premise of this episode. We started by exploring how macroeconomic rules feel completely fractured right now, and how navigating the corporate landscape is akin to running an obstacle course blindfolded.
It is an environment that actively punishes fragility and rewards extreme discipline. Flexsteel navigated the immediate obstacle, the initial wave of inflation, by successfully flexing their pricing power and passing $9.5 million in costs directly to their consumer base.
They did. But here is the final provocative thought I want to leave you with. Something to consider as you watch not just Flexsteel, but every single company in your portfolio that relies on importing physical goods. Flexsteel passed on that first wave, and the consumer absorbed it. The elasticity held. But with credit card balances at all-time highs, savings rates plummeting, and discretionary budgets tightening across the board. What happens when Flexsteel is forced to pass on the costs of this new 25% tariff?
It is the ultimate test of elasticity. Everyone has a breaking point.
Exactly. It's the psychological threshold of the American consumer. At what specific dollar amount does a loyal premium buyer simply look at the price tag on a new sectional, shake their head, and walk out of the showroom? And if they walk out, do they trade down to a cheaper, lower quality competitor? Or do they simply decide to sit on their old frayed couch for another 3 years? The answer to that specific question is going to dictate the survival of the entire retail sector over the next 18 months.
It is the most critical variable in the global economy right now, and it is playing out in real time on showroom floors across the country.
It's the multi-billion-dollar question.
Yeah.
And it is a metric we are going to be tracking relentlessly. That is going to wrap it up for us today. Remember to always check the primary sources, read the footnotes before you trust the headlines, and stay sharp. We will see you back here for the next deep dive.